All right, hello and welcome everybody. Doug here with thelincolnlist.com. I want to welcome you back to another weekly edition of Whiteboard Lessons. Today's topic will be what is short selling, how does it work, and what are the scenarios that may arise where you will need to learn how to short sell or where short selling is advantageous to your trading business. As I always say at the very beginning of these videos, if you like the educational content that we are delivering, be sure to keep up to date with thelincolnlist.com by subscribing and showing your support to our channel. So I'm going to try to do things a little bit differently here. I want to start out with doing my best to do the technical definition on how it works between you, the broker, and the back end. For those that really need to know exactly how everything works. Then we'll do the layman version where what you really all the stuff that you need to concern yourself with knowing when it comes to short selling. And then we'll go through a couple of scenarios about the advantages and disadvantages of where short selling or why you would need to know how to short sell stocks. So here what we're going to start with is to get on the same page. Let's look at it this way. When you're brought into trading or investing, it's pretty much 100% a buying or a bullish bias where you are told that you buy a stock and you will sell that stock at some point in the future, and whatever the difference between where you bought it and sold it is your profit. The easiest way to think about short selling is the alter ego of buying. It's sort of like Speed Racer's Rex Racer or Superman and Lex Luthor, except for short selling is really not the Lex Luthor. It's not really that evil, and you'll understand that by the time we get done with our video. But the purpose of short selling, or how short selling works, or the easiest way to think about it, is you are selling a stock today with the intent that sometime in the future you will buy that back, also known as covering. You will buy it back in the future at a lower price, and you will be able to pocket the difference from where you sold it to where you covered it. It may seem a little confusing, but by the time we get done with this video, the few examples, you will understand completely how this works. So let's try this technical definition. Let's say you feel that XYZ stock is due for a downturn in stock price, okay? And you want to make money. And as I said, the one thing I want to establish here is shorting is just another way for you to make money. It doesn't judge you as a character or say that you have this long-term negative bias about a company or you're some evil human being or you're just negative and you're doom and gloom. But I always say this to everyone at the Lincoln List is that the stock market and stocks themselves don't go up or down. They go up and down. There's constant price changes in stocks. And you as the trader have this in your toolkit. You're able to capitalize on stocks that are both going up and you're able to profit when stocks are going down. And stocks do go down, and this is why you should learn how to short sell. But that's another topic. We'll get to that later. Thanks for paying attention to my rant. So let's say for whatever reasons you feel XYZ is going to decline in price and you want to profit for that. So the easiest way I'll do this is, let's say there is you, your broker, who you do business with, and you and your broker's clients. All of these people over here, some clients. And they all have deformed bodies here now with my poor drawing. Okay, they look like the Blair Witch. These are like the Blair Witch people. Okay. When you buy a stock, they have what they call as a float or shares outstanding. So there are always shares available from most companies. So whenever you want to buy it, there are shares that are available to buy. When you're shorting, you're not buying, you're doing something that is called borrowing. You are borrowing shares, okay, on loan. So how this works technically is if you want to short sell this XYZ, you will go through your broker. Your broker will borrow these shares from the current pool of clients they have. So let's kind of give an example. Let's say Joe right here, he's a chef. I gave him a little chef hat. Let's say he has a 401k and he has, a bunch of XYZ shares just sitting there or whatever. You want to borrow some of this. So let's say you want, for math purposes, you want 100 shares of XYZ at $10 per share. Okay. So what your broker does is they go into their client's accounts, I forget his name, Joe, whatever we decide to call him. They will take the shares and they will put them into your account, allow you to borrow these shares. Now, Joe here doesn't know that's going on. When you sign up for a brokerage account, that's basically what you're doing with your longs, is they can take your stock. Now, saying take your stocks is a term I'm using loosely. If someone takes your stocks and you look into your account, it doesn't say, oh, these stocks are being loaned to Doug at the Lincoln List because he's shorting it right now. It doesn't work that way. It's just they are on loan and they are at borrow, and we'll try to explain that a little bit deeper not to confuse you. So what your broker does basically is they put this 100 shares position at $10 a share. So let's say that's $1,000. They credit your account for $1,000, okay? Now you have those shares on borrow. They are yours. Let's say that day you get a $1 price drop. This goes down to $9 per share. Okay? So XYZ tumbles, it goes down to $9 a share. You take the $9 shares, you buy that back, right? You buy these shares back, and then your broker takes them and puts them back into Joe's account. Now how this works is this way, where the profit comes in on the technical side. You borrowed at 10, which was a $1,000 credit. You are selling them back to your broker who puts them back into Joe's account, but now the price of the stock or the net worth of the stock is $900 because it dropped a full dollar in price. It's down $100. Now it's $900. So all you're giving back is the $900, okay? Which means you get to keep the difference between the $900 and the $1,000, which is $100. So that's how it technically works. Now it's even deeper than that because the broker doesn't always have to necessarily go through just its clients. It can borrow them from other brokers' clients. It's a deep game, but you know, that's the way it works. Now let's move on to the easier part because this is where it's going to fit about 99% of the people and what you really need to concern yourself with short selling. In every brokerage account, you have you have two beautiful buttons in most orders. You have what is a buy button and you have a sell button. And they're really cool these days because one's green and one's red. It makes it real easy for you, right? So when you want to buy a stock, you click the buy button. When you've had enough of that stock, you're done with the stock, you click the sell button, you're out of it. Because all of this stuff is automated, you're never going to see any of this stuff that goes on behind the scenes. Same way with buying. In the old days when you used to buy stock, you would get issued the certificate. Now, that doesn't even happen anymore. To short selling, it just works, like I said, it's its alter ego. You see a stock at a price, you sell at that price, then you simply buy it back at whatever price. So when you see this thing hitting a certain intraday price, you see it hit $10, you just click the sell button, and then if it drops down to 9, you hit the buy button, you cover it, or wherever it hits your target. Now, if it doesn't work out and the stock goes to $11, it goes the other way, then you can still buy that back, but at that point, it will be a loss. So again, the easiest way to look at this, it's the alter ego, and it works the exact opposite of buying. Buying, you intend to sell at higher prices. Selling, you intend to buy back at lower prices and pocket the difference between wherever you sold and then you covered. So now the question becomes, what is this for? And why on earth would anybody want to do something like this? It sounds evil to some people. Some people just say, oh, it's the worst thing someone can do. You hear people say, shorters are evil, they're awful people. No, they're not. They're great people. They give to charity. They do great things in this world. And they keep the balance of power. So let's talk about some serious things of why this is important. I think one of the ones is the fear versus greed topic, okay? Fear is a much stronger emotion than greed is, okay? So when a stock goes up, people are greedy because they're afraid they're going to miss out. So they chase stocks. Or when stocks go up, they have greed and they hang on to positions longer than they can. This is maybe a little bit deeper topic with psychology, but I'm just going to give you a little overview. That's greed. But when people are scared, you see the market dropping, they see stocks going down, they panic. And panic, stocks always, we have this saying that's been around the stock market forever, that stocks take the the stairs up and the elevator down. So traditionally, stocks will decline 2 to 3 times faster than they will increase. So you'll see it many times. You look at a chart went up 7 to 10 days in a row, and then one afternoon it gives it all back. Very common, because again, it's the fear versus greed. Fear is a bigger emotion than greed. What this means to you is that your profits with shorting are generally larger and faster. Faster as in time when you have to wait for them if you do it right. So the fear versus the greed is one reason why someone would want to short, because stocks go down faster than they go up traditionally. You can make faster money and you can make more of it if you understand how short selling works. Another thing is hedging. Okay? For example, if you owned XYZ in a 401k account and you didn't want to sell it because maybe there was a dividend or something like that, or maybe you have restricted shares, or maybe you're talking about 2 different sectors. You own an oil, but you think the oil stock's going to go down, so you want to hedge against oil overall to protect your position, just like people do with options. There's different scenarios that may come by where you feel like you want to hedge a position by going with something else in another sector, or hedging with an ETF or something like that, whatever your choices is. But hedging allows you to take advantage of short-term declines in the prices, protecting some of the long or some of the positions that are in the account. So for example, if this XYZ, you feel it's going to go down, and maybe it's a computer tech company, okay, you could short a computer ETF, like an electronic traded fund. You could short one of their competitors or something like that, where you feel the whole industry is going down. You could short another stock in the industry. Again, there's different ways that you can use shorting to your advantage to help you make money. More importantly, you should, if you're going to survive, every trader that I know, whether they're a long trader or a short trader, everybody knows how to short or how short selling works. You have to in order to survive. Because we've always said at the Lincoln List, if you want to be successful, one of the keys in doing that is knowing who's on the other side of your trade. So when you're a long and you are buying a stock and you're looking for a certain price target, it's important to know where shorts are, right? Like, where would the shorts be? Where would shorts be thinking about entering? When does this chart become bearish and the shorts start attacking my long position? So even if you choose not to short a stock, knowing where short sellers are, where they think and how they operate, allows you to protect yourself with some of the long positions that you have. So some great advantages for shorting. Couple of the disadvantages. I mentioned at the very beginning that you are borrowing your stock. And because you're borrowing your stock, at some point you have to give it back. You cannot short a stock for 75 years like you can just buy and hold forever. At some point, Joe's going to want his shares back, right? Or he's going to sell out his position, or the broker's going to run out of them, and they're going to want these shares back. Now, in a lot of cases, if you deal with high volume stock, let's say like your popular ones, Apple, Google, Tesla, they have a lot of outstanding shares. They have a lot of shareholders. So shares are easy to borrow for those stocks, which means they'll have a lot of them. You'll be able to hold those longer. But when you get down into some things like some of the lower floats, let's call them low floats, cheap stocks, right? Cheapies. You have 2 problems, two big risk problems. One is not being able to get shares because there are not that many in the float in the first place. So sometimes there's a really slam dunk, you're like, oh boy, this is a tier 1 opportunity, but it's very difficult to find shares. So if you decide to short, sometimes you cannot because your broker does not have the shares. Now, if you trade long enough and that's a strategy that you use, you will also find out there are plenty of brokers out there that specifically deal with short sellers, so they have an adequate amount for those that want to short. And also when it comes to these, let's say the cheapy stocks, you're often exposed to a lot of fees because it's harder for the broker to borrow. So when it becomes harder to borrow, but not in all cases, like I said with Google, Netflix, the Amazons, They have a lot of shares available. They're usually inexpensive to borrow. But when it comes to the ones that are harder, sometimes they charge up to 99% or more, and it just doesn't become worth it to you to short it because the fees are too much to actually do that. So kind of keep that in mind if that's something that you're going to do. Also, there's always the case that many will say that stocks can go up unlimited. It doesn't happen all the time, but you do need to be aware of everything, is that if you buy a $10 stock, it goes to zero, the most you can lose is $10. But that $10 stock, in theory, could be bought out overnight for 30, 50, 100. You know, we've seen things like that happen. So when you're shorting overnight, there is that risk that that company could be bought out, or news could come out and that stock could be a KBIO. That's why I really don't agree with shorting the penny stocks or the low floats or holding onto those, because that's what happens sometimes. You get a KBIO, which will just kill your account, or a VLTC, where stock goes from 4 to 40 and you run out of money. Because what will happen there is you'll be margin called. You hear about margin calls. Your broker will call you in on these stocks. That's what happens with some of the lower float, the cheaper stocks. They're vulnerable because they're harder to borrow. Not only do they have more fees, but you can be called in. That's what sometimes you see short squeezes, margin calls, that kind of stuff. That's what creates a lot of stocks to actually go up, is because all the shorts have to be bought in. So those are kind of the bigger disadvantages. Again, they don't happen all of the time, but there's advantages to longing and there's disadvantages to longing. And there's advantages to shorting and disadvantages to shorting. Everything has a time and a place. And the thing that I wanted to make clear that we talked about pretty much at the very beginning was whether you choose to do it or not. Every professional trader I know at least knows about it, because you need to understand how both sides of the trade work. If you are a long trader and you want to stay with longing only, it's important to understand how shorting works, how short sellers think. You want to know where they are. You want to know where they're going to cover, because that's going to help you maximize the profits on your trade. And that's going to help you understand if your stock is falling down, where the short sellers are going to start piling in, and it's going to get worse for you and you need to take your losses and run. So it's important to know. I would always suggest, because I think it's a great way to make money in these day and age, for you to be successful, you need to be a well-rounded trader. Someday the advantage is of being long. Someday that advantage is of being short. And for a really good trader, you have to be able to drop your biases, switch on a dime, and short a stock, long a stock. Sometimes we short and buy the same stock within the same morning, sometimes 4 or 5 times within the same day. Because as I said, stocks don't go up or down, they go up and down. And there's price in fluctuations throughout the day that you can capitalize on. And why deny yourself the opportunity, right? Take advantage of it. So I hope this lesson helped you understand what short selling is. As always, if you need some help, make sure you visit thelincolnlist.com. Take a free trial to our live trade room. Until next time, take care.